If you're interested in investing but would like an alternative to buying individual securities, you may want to consider management investment companies. You may be somewhat familiar with one type of management investment company, mutual funds, which we will discuss later. But for now, let's go over some basic characteristics of management investment companies. Generally, a management investment company collects money from multiple investors, creating one larger account with which it invests in various securities within or across a variety of industries. Shares are then sold to the public, each representing a portion of the overall holdings in the portfolio. Each investor is part owner of the pooled portfolio, but they do not choose the specific securities in which it invests. Rather, the management company's officers or board of directors hire an investment advisor to manage the portfolio. The composition of a management investment company's portfolio will vary based on certain qualities. Management investment companies can be classified as either closed-end or open-end. Closed-end investment companies offer a fixed number of shares for public purchase. Shares are first made available through underwriters in a single offering, after which they are bought and sold on the secondary market at prices influenced by market conditions. Closed-end companies can invest in various securities, including common stock, preferred stock, and debt securities like bonds. In contrast, open-end companies, or mutual funds, can offer an unlimited amount of shares, distributing them continuously. This enables the company to generate a potentially indefinite amount of capital. However, unlike closed-end companies, mutual funds allow investors to redeem their shares or sell them back to the company, rather than trade them on the secondary market, which ultimately reduces the fund's capital. There are various types of mutual funds in which you can invest, and we will discuss them in more detail in later videos. One of the obvious benefits of investing in management investment companies, both closed and open-end, is diversification. Because investors own shares of a fund or portfolio instead of individual securities, their risk is spread out across many smaller investments, rather than just in the stocks or bonds of a single issuer. However, in order for a management investment company to be considered diversified, its portfolio must meet certain criteria, specifically the 75-5-10 test. As per the test, 75% of the management investment company's assets must be invested in outside companies, those with which it is not affiliated. Of this portion, the amount of assets invested in a single issuer's securities cannot exceed 5%. And the fund cannot own over 10% of any issuing company's outstanding securities. The remaining 25% of the total assets are not required to be allocated in any particular way. If a fund does not meet these qualifications, it is considered a non-diversified investment company. Another advantage afforded by management investment companies is professional management. But keep in mind, you will often pay for this service with sales charges and fees, which will ultimately reduce your return. As with all investments, be sure to determine and acknowledge the risks you may encounter when investing in closed-end and open-end funds, such as capital risk, market risk, and interest rate risk, just to name a few. To learn more about this and other investment topics, subscribe to the Zions Direct YouTube channel.